This podcast is for informational purposes only and does not constitute investment, tax, or legal advice. Consult a qualified professional before making investment decisions. You should carefully listen to the full disclosure at the conclusion of this episode or review it thoroughly in the show notes.
If you sat down for a drink with Bruce Springsteen, would you rather have him give you a bunch of bullet points about songwriting theory? Or would you really prefer to hear the story of writing born in the USA? I thought so. That's why here on Impact Investing Roadshow, we believe the best way to understand an investor's craftsmanship is to hear them dig deep into the story of a single investment. I'm your host and tour guide, Mark King. On this episode, you and I are going to hear from Mark Phillips, the founder of 11 Tribes Ventures. 11 Tribes is a Chicago-based venture capital firm built on a simple but unique conviction that what happens to the founder of a business is more important than what happens to the business. Mark set out in 2020 on a mission to rethink and reshape the venture capital model. He and his team want to back technology companies that are more sustainable, more durable, and ultimately more profitable by keeping the focus squarely on the founder. Mark's path to venture was anything but conventional. He spent the better part of a decade as a strategy consultant. First for 4 years at Accenture, and then 3 more at Point B, where his work centered on strategy and M&A. Along the way, he went back to school for his MBA at the University of Chicago's Booth School. And while he was there, he launched his first company. That experience, and specifically the not-so-happy ending, became the seed of what would eventually become 11 Tribes. In addition to his MBA from Booth, Mark holds a bachelor's in math from Wheaton College, which is a little surprising because, as you'll hear, he thinks more like a sociologist. He lives in the western suburbs of Chicago with Emily, his wife, and their 3 boys. That's a little weird. I feel like I just introduced myself. A guy named Mark from Chicago's western suburbs with 3 sons, a degree from Wheaton, and that's into tech startups. On top of all that, Mark Phillips is also a podcaster. I wonder why we get along so well. Joking aside, Mark and I had an awesome conversation. We started by talking about the 11 Tribes origin story. Mark, let's start with some background around 11 Tribes. You're into your second fund and have been at it, I want to say 6 years now?
Yeah. I guess we're in 2026, so that makes it 6 years. Happy to provide it. Everyone should know that you are, as you know, Mark, somewhat responsible for these decisions that I've made. So you've given the background, but when I was coming out of school and in my early days of consulting, I was really intrigued by venture capital and found this old podcast called Distilling Venture Capital, hosted by none others than Mark King. So listen to that. At some point, you referred to your time at Wheaton College. And I said, there's an alum of Wheaton College who works in venture capital. I have to know more. So you and I, that's where we got connected. Through a long and winding journey, I became passionate about this journey of entrepreneurship. And what does that mean in terms of, yes, the growth of a business? And that's what we're here to talk about today. But so much of the journey, Mark, as you know, is the growth of the founder. I've experienced that for myself. And as a fund, we're genuinely really passionate about what it takes to help leaders grow. And so 11 Tribes came through some of my own entrepreneurial failure. A lot of my faith is built into what I do at 11 Tribes. A lot. Our North Star is Mark 8:36. What does it benefit a man if he gains the whole world, yet forfeits his soul? And so I quit my day job actually in the midst of COVID. May of 2020, I said goodbye to a consulting firm I'd been with for a couple of years. Didn't really know what I was doing, if I'm being completely honest with you, but found our way into raising a first fund of $11 million, which launched on April 5th of 2021. So we've deployed that into 33 portfolio companies. We'll talk a little bit about that, I'm sure. And then in March of 2025, we closed on our second fund, which was a $46 million vehicle. and have now invested into 14 companies. We expect to do probably 10 to 15 more deals over the course of the next 18 months. Yeah, I could go on and on about all that. We've changed our strategy quite a bit. That's a big leap in fund size. And so we're now lead investors as opposed to follow-on investors. But that's the tactical kind of how old are we as a firm, where are we today, and what kind of capital are we deploying as a fund.
And venture has gotten to be broader and broader in its definition and mandate. So tell us about what are typical deals and what the strategy was and how it's evolved into leading deals.
I really came at this more as an operator as opposed to an investor. I'm not a traditionally trained investment banker. I'm a consultant and entrepreneur is really how I see the world. And so when we launched Fund One, our thesis was always this idea of, yes, founder outcomes are as important as what we call business outcomes, right, Mark? And so, right, we all know what a business outcome is. You know how to measure that, IRR, cash on cash, whatever metric you want to use. But how do you measure a founder outcome? You could talk about the quality of relationships in that person's life. You could talk about their mental health, their physical health, their spiritual health. It's a lot harder to measure, if we're being honest. But the thesis for us has always been, what if we were as committed to the founder outcomes as we were to the business outcomes? And that manifests itself in a few different ways. But what's interesting to your question is when we were deploying out of Fund One, while the why was very strong and the unique value prop was very strong, how we invested and in what types of assets we invested was not very strong. We were following on into big funds that had a lot more assets than we do, had different underwriting methodologies, had different performance metrics. And I think this is what a lot of entrepreneurs don't fully appreciate is like not all VCs are created equal. If you're talking to 11 tribes, we have a very different underwriting methodology and strategy than Andreessen Horowitz. And the check sizes themselves tell you a lot about what's going on. The fund sizes, right? Andreessen raised $15 billion last year. That's crazy. That's crazy.
Yeah,
And they're supposed to return 3x.
I saw that number. And at some point, probably back when I started, that was the size almost of the industry.
Whole industry.
In a given year.
I mean, this whole thing started as a cottage industry. I mean, I think I read somewhere that Sequoia, Excel, KKR and one other were the first four funds. And cumulatively, the first four funds ever created were a total of $12 million. So we've gone a long way. You're right, Mark. Where we are today, the why hasn't changed, okay? We legitimately care about founders. We have what we call our founder result about, Mark. We allocate 2% of every dollar we invest non-dilutively to the founder of each portfolio company for them to pursue their own growth and resilience. So that might be coaching, that might be counseling or leadership development, marriage counseling. We've had founders engage in marital counseling. Which is amazing because if your spouse isn't bought into what you're doing, you're done, man. You're cooked. But what has really evolved is our allocation methodology. And what I mean by that is we're not just looking for a deal that, hey, maybe Andreessen Horowitz or Sequoia comes around and follows on and gives us a big markup and we all win. We're actually asking the very difficult question now of, in the age of AI, what does it mean to build a successful, profitable, cash flowing business? Sam Altman of ChatGPT has this great thought, which is, he and his buddies have this betting pool going of when is the first single person $1 billion organization going to be in creation? When is it going to exist? And I have a flip side of that same wager. I believe there's going to be a massive proliferation of small 3 to 5 person teams that can reach 50 to 75, maybe $100 million of revenue in under 5 years because of the pace at which artificial intelligence allows them to grow. And so that begs a really interesting question of like, venture has always described itself as a power law industry where only the biggest outcomes can win. But we're asking ourselves, and now getting really down to the specifics, what does it look like for us to focus not on unicorn outcomes and home runs, so to speak, but on more singles, doubles, and triples? And so for those that know the movie Moneyball, we really are starting to feel this is where we're headed as a fund. And really, I believe as an industry where you find someone who's worked in the waste management industry. We've done this deal. I'm speaking from a specific example here. Understands the space intimately, realizes that artificial intelligence can help them solve a very specific pain point they've experienced for the last decade. When they enter into that industry, they're solving the pain point in a very specific fashion. They have the right contacts to grow their revenue, and they're able to scale the business at a pace that they otherwise could have never imagined. So what we look for are deals that are generating $500,000 to $2 million of revenue, raising on something between a $15 and $25 million post-money valuation. And we underwrite their growth, Mark, to 10x, meaning we are excited. We expect that they will sell their business for somewhere between 50 to 100 and $250 million. 96%, interesting fact, 96% of all M&A activity in North America over the last decade has occurred $100 million enterprise value or less. So you've got all these venture funds that are squabbling and tripping over themselves to get into the next unicorn, while we're asking ourselves, what does it look like to build businesses that have sustainable profitability and a huge universe of buyers that are interested in buying the company that they're trying to build?
Talk about kind of industries that you focus on and maybe geographies as well, because you're based here in the Chicago area, but talk a little bit about kind of where you're looking for those founders and what industries are you looking for them?
Yeah, geographically, it's not so much that we have a mandate that we'll never invest in San Francisco, right? But what we are, when you kind of play back that allocation strategy, price matters. And Warren Buffett has said this for years. Venture has convinced itself that it's not true. I'm going to go with the guy who's got an incredible track record of performance, right? Price has to matter. And so we are geographically constrained by price. And what I mean by that is we observe consistently what we call geographic price arbitrage. When you're doing a deal, could be the exact same deal, Mark, same founder, same revenue, same market. But if that deal was raising in Chattanooga, Tennessee, as opposed to San Francisco, California, as investors, we're probably getting a 3 to 5x discount on that organization. That's crazy. And so, yeah, we are focusing on the Chattanoogas, the Nashvilles, the Chicagos, the Indianapolises, the Austins, the Denvers of the world, not playing the coastal VC game, because all the things I just said about singles and doubles, how big is big enough, frankly, Mark, those are not questions that coastal venture firms or coastal entrepreneurs are asking themselves. From an industry perspective, I love to say we go where great founders want to take us. I was a failed healthcare founder, right? I tried to build a company in the healthcare space. It didn't work out. I'm not going to pretend to know more about the healthcare industry, the gold industry, the waste management industry than the founders that we work with. So we will go where great founders take us, and we'll get into that as we discuss our deal here and how we think about great founders. But what we really are kind of, we have to be somewhat specific in what we look at. We talk a lot about vertical AI at this point as investors, and all the allocation things that I'm talking about really come together nicely when you look at a vertical solution. And what I mean by vertical is, it's easier to talk about the antithesis, right? Horizontal are businesses like Salesforce or Microsoft or Workday, right? Hey, Workday is an HR solution that can apply to waste management, healthcare, financial services, and banking, right? It goes across every single industry, which is why it's so big. But AI really, because we can analyze so much more information, you're going to start seeing solutions that build vertically. And it's to say, hey, I'm a solution that is specifically designed for waste management. I'm specifically designed for hospital trauma registry departments. I'm giving specific examples here from our portfolio, because now we can collect so much more information and we can build a solution that up until now was not possible. But if I can bring all these component pieces together, I'm going to delight the customer and I'm going to grow a really, really exciting business. So intentionally, we're generalist funds, Mark. But I really anchor back to what I said at the start, which is we love to go into industries where great founders want to take us.
Well, speaking of diving in deep on a vertical, let's dive into the transaction you wanted to walk us through today. I believe you said it's NQS, National Quality Systems. Give us the high level of who they are and what they do, and then we can get into how you got involved.
Love it. Absolutely. So NQS is part of our Fund 2 portfolio. The founder's name is Mark Feinberg. Accidental. Now we have 3 Marks on the call, which is on this recording, which is fine. Mark's a wonderful guy. He lives outside of Jacksonville, Florida, and is a multi-time founder. Has built and scaled multiple companies. Most recently was a healthcare consulting organization. We met Mark through a co-investor relationship. To be honest, I wish the story of how we met him was more glamorous or something, but this is the truth of it. The best deals in our industry come through relationships. We had a relationship with a co-investor. The deal was a little bit bigger than he wanted. He passed it along to us and we were delighted, absolutely delighted. And so Mark is solving this really interesting problem, which is how hospitals manage their trauma registries. And so what is a trauma registry, you might be asking? It is the log of all the things that are coming through the emergency room. And so there's all these codes, there's all these pieces of information that are required to go along with every single registered event from the trauma department to make sure that reimbursements can happen, to make sure that the payers and the payees, all of these things that go along with the insurance that comes into the hospital, everyone can be paid out and reimbursed accordingly. Now, what's interesting about this industry, Mark, is it's exceptionally small. Exceptionally small. And this is not, the company I'm going to tell you about, NQS, is not the sort of organization that traditional venture firms who have this, what I would describe as really incoherent investment strategy, which is like, I only need billion-dollar outcomes or bust. There's so much good money to be made, we believe, in small markets, especially when we bring artificial intelligence in. The trauma registry departments in the United States total 2,400. There's 2,400 trauma registry departments in the United States. That's the whole domestic market. Now you can go international, and that certainly changes the tone. But I mean, you're talking about in total maybe a $1 to $1.5 billion market. But when we looked at it, and after we started to get to understand Mark and his passion for the space, his expertise for the space, what we found was there was only one meaningful competitor in the industry. And it is a conglomerate software organization that does software for not just healthcare, not just trauma registry, but dozens of different industries. They make these very cookie cutter software. I mean, we know the type, it's like going to a deli or a diner and they're like, yeah, we make pancakes, breakfast burritos, T-bone steaks, and we serve masticholi on Saturdays. Like you can't do all of those things well, right? Like I'm not going to go for the T-bone steak there. I'm going to go for something very basic because I don't trust what's happening in the back. It's the same with the trauma registry world. They had one option, and that option was trying to keep dozens, if not hundreds of different types of customers and industries happy. And so Mark Feinberg saw opportunity.
When you first got engaged with him, up and running, pre-development, was it what we used to joke as slideware? Was it all just PowerPoint? I understand kind of stage that he was at and your preference for that.
We met Mark in late spring of 2025. Yeah. So I want, maybe it was February, March. And it was pre-product. The organization they were finalizing the build out. But what was really interesting about it, Mark, was that they had, I'm going to pull up my numbers here. They had committed revenue from 16 different hospitals. That was really interesting to us. And I share that very intentionally because it was a meaningful part of our decision-making process. For those of you that know what the sales cycle of hospitals is like, it is not for the faint of heart. We have a model in our fund. We've got a group of operating partners, and these are folks who, unlike myself, have built, scaled, sold companies in the various industries that they are passionate about. And one in particular is a woman named Carolyn Wilson. And Carolyn was the COO of the University of Chicago healthcare system for about a decade, went up to Michigan and worked at Beaumont Health, has just done basically everything in the healthcare industry that you could management of healthcare industry that you could possibly do. As we started to understand what Mark was doing, we were genuinely a little uncomfortable with the pre-revenue nature of the business. It's not typically where we invest these days. We want to see some validation of customer and traction, et cetera. But he kept coming back to this committed revenue. We saw the contracts, we saw the signatures from the hospitals, and we couldn't shake that feeling. And so as we do in our decision-making process, we kind of orbit that decision. We bring in other perspectives to try to inform what we're doing. And so we called Carolyn and we said, Carolyn, here's the deal. We really like the company. Here's the value prop, but 16 hospitals have already signed contracts with this guy. And the product is still 6 to 8 weeks away. And her jaw dropped, Mark. Her jaw dropped. She's like, hospitals do not do that. So one of two things is true, maybe both. Number one, the product is otherworldly. Mm-hmm. And for anyone that's built a software product, like that probably isn't true because it's early and it needs time. Or number two, the pain point is so visceral that these people are desperate for a solution.
Yeah.
And I believe number one will bear itself out, and it's been about a year now, and the product is growing better every day. But number two was the most accurate assumption that we made in our underwriting process.
Yeah. Did you talk to some of the 16?
I think we had 3 customer conversations or signed contract conversations. And then Carolyn helped us introduce Mark to 2 different hospital systems. And that's one of our favorite parts of the diligence process is let's introduce you cold to a customer and let's see how you do, right? And Mark Feinberg did great, and continued to validate this perspective that the options in the market today are just atrocious, absolutely atrocious. And it's a pain point that all of these trauma nurses and doctors and administration are feeling day in and day out.
You mentioned that you got it from a co-investor. Did you guys lead this one yourselves? Tell me kind of how the structure of the round came together.
We did not lead it, which is unusual for us. We've done, like I said, 14 deals. I think we've led 12 of them over the course of the last 2 years in Fund 2. The reason we didn't was because another great investment group, a group called Long Run Capital, and the partner there's name is Wilson Patton. Wilson and his team had met Mark probably 3 or 4 months before we did, and they'd been talking for some time. Have a ton of respect for how Wilson operates. And that was an important part for us. If we had a diametrically opposed underwriting process and growth profile from the lead investor, that's probably something we would walk away from. I think misaligned expectations are one of the great destroyers of value in this world. But we have a really aligned perspective with Wilson and his team. And so he led the round. Unusual for where they were in their development, Mark. They actually priced it. And so for those that are new to this world, there's a few different vehicles you can use. The most quick and dirty is what's called a SAFE, a simple agreement for future equity. I think market standard right now, we see a lot of convertible notes, which is effectively a debt vehicle with a small dividend of maybe 6 or 8%. But for more mature companies, you price it, which means you put structure, you issue shares, you put a price per share on the company. And you don't usually see it for companies that are pre-revenue. The reason we did that was because we had a lot of confidence in Mark. Mark's, I don't know his exact age. He's probably in his early to mid 50s. Mark has been around the block, right? He knows what it takes to price an organization. He knows the governance constraints, right? Protective provisions, negative covenants that come with a priced round. But when you price around, you force an organization to mature, I think, at an even faster clip than it might otherwise. And I think that's really healthy. And for those that are listening, the other component of pricing around is what's called qualified small business stock. For those that don't know, this is a really interesting tax provision. And you're grinning ear to ear over there, Mark, because it's so attractive. But the IRS is a little ambiguous about whether safes and convertible notes apply as qualified small business stock. But if you issue a stock to a small business that has less than $50 million of assets, and you hold that stock for 5 years and then you sell it, you get 0 federal income tax. There's no income tax from the federal level.
How do you go about having the alignment and values conversation with co-investors? And how do you have a conversation with the founder about the co-investors?
Maybe I'm naive in this, but I'm just extremely direct. It's actually more nuanced than that. One of the things we've really developed and intentionally put a lot of effort behind over the last year is what we call our handshake agreement. It's our philosophy of partnership. And I'm really proud of it. Like, it's one of my favorite things we've ever created. And it says things like, as the founder of this organization, I acknowledge that my mental, emotional, physical, and spiritual health have a direct impact on the performance of my company and the stewardship of the funds that investors are investing into my business. And so as a founder of 11 Tribes portfolio, like, I'm going to ask myself, how big is big enough? I'm going to ask for, I'm not going to hide when I need help. I'm going to fully pursue my founder resilience commitment and continue to grow. That is an amazingly clarifying document in our investment process. And we send that, it goes to the founder probably at the 75% mark in terms of our diligence process. So we're not all the way there. It's not the 1 yard line, but we're in the red zone, so to speak. Mm-hmm. And a handful of times, Mark, it's killed the deal. A founder has read it and he said, this is not something. This is not how he or she says. I'm not interested in building with this methodology. And so we wish them the best of luck. It's no hard feelings. Like there's no one way to build a business. I just think a lot of people have led themselves to believe that the only right way is that unicorn outcome. And we're simply trying to help people understand that there's more than one way to go about it. So when I shared that with Mark Feinberg at NQS, when you share it with someone that resonates with what you are offering, it's an incredibly trust-building exercise. In that moment, Mark Feinberg really felt like, wow, this is an organization, 11 Tribes. This is an investment firm that really understands how I want to build a business. And so that was really, really special. So that's how we do it with the founder. And then as I talked with Mark and I got to know Wilson at Long Jump, it just became clearer and clearer. One of the things we did a lot with Long Jump was we asked them about their existing portfolio companies. Tell us about who you're on the board with. Tell us about some of the exits you've experienced. What's got you excited? What doesn't? And when you just sit back and listen to an investor talk, what really enthuses them is going to come to the surface very quickly. Is it vanity metrics? and quick markups, but a lot of value destruction and burning of cash? Or is it profitable businesses that are growing with sustainability and durability, that are focusing on the fundamentals and really targeting a reasonable outcome for their business? If it's the latter, that's the kind of organization and investor that we want to work with.
Yeah. You mentioned also that you had given Mark Feinberg some homework in terms of calling a cold prospect or doing a sales call with you.
Yeah.
What other sorts of homework did you give him, if that's the right word?
Yeah. The two biggest things I'll give you are financial model at whatever stage is really important to us. And I think I've met enough founders that feel, they can kind of put their finger to the air and, get a directional model going, and that'll be enough. But, I think what you can't measure, you can't improve, right? So if you're not tracking information and assumptions about how you're building this business and what financial metrics need to be controlled for, that doesn't make me feel good about, where that company's going to go.
Right.
So Mark had a really good model in place. We pressure test those models quite a bit and push back on him in a number of different ways to make sure that we felt comfortable with the assumptions that he was working with. But the second piece that we ask each founder to do is really a psychometric profile, Mark. What I said a few minutes ago is, right, we want great leaders to take us where they want to go. Well, how do you know what a great leader is? We have wrestled with that question for years, and I don't have the answer, so sorry to disappoint, but I have a couple ideas. We use something called the culture index. And I'm a bit of a nerd on this stuff. Like Enneagram, Strengths Finders, DISC, the list goes on and on. Teamalytics, Colby Index. Like there's all these different profiles that you can use. I've never seen anything quite like Culture Index. So it's a profiling software platform that's been around for about 40 years. And it doesn't give us whether you're a good founder or a bad founder. What it does is it gives us a profile. And there's 4 different categories, whether it's visionary, research, coordination, or social. And what we've really come to realize, Mark, is, again, there's no one right answer for a founder, but there is a right answer for how you compose a team. And so if you have a team that is full of simply visionary, right? I'm in that category. Like, I like to move fast. I'm not really worried about the details. Let's make sure we get the job done and we accomplish all of our goals. That's going to make my day. If you build a team of entirely visionaries, like I love this saying, more companies have died of indigestion than starvation, right? You're going to consume a lot of stuff, but do you have the ability to process and metabolize each of those different component pieces that you're taking in? So what we asked Mark to do was to use the culture index, take it for himself. We had a big, long conversation. He's in the visionary category. He's this profile called the philosopher, which has a lot of gas pedal, but also has a lot of focus. So he moves very fast, but on one thing at a time. And I think that's really cool. I move really fast, but I like to work on like 6 things at once, which my wife tells me doesn't work. She's probably right. So that was really fun. And we also asked the rest of his management team to take it. And then we were able to have a conversation with the management team about, here's what we see. Here's the good we see. And also here's the things that might turn into issues. And those conversations do a couple things, right? I mean, I think it's really healthy to have that conversation. It informs them about maybe things they didn't realize before. But it's also so interesting, Mark, right? Because when you tell someone there's something wrong with them, the colloquial, your baby is ugly, you learn something about them, right? You learn, are they able to take feedback? Can we have healthy conflict? And what I was so impressed with Mark's team was not only was there healthy conflict, they welcomed it. They asked for more. And it's not me suggesting that I've got all the answers, but it is a disposition that I think a leader can create within the context of their team of, do we think we have all the answers, or are we humble enough to admit that we need help? Pat Lencioni's ideal team player, he talks about 3 attributes, right? Humble, hungry, smart. And Mark checked all 3 of those boxes with flying colors during our diligence process.
Really appreciate you diving into that data gathering diligence stuff. I assume the throwaway comment is, and I assume you researched the market, and I assume you talked to some customers, blah, blah, blah. But clearly those are the things that kind of differentiate your approach. So I appreciate you diving deeper on those.
That's well said.
But you've got all this stuff. You mentioned this concept of circling around a decision. Talk to me about how you guys actually make decisions.
the things you said that didn't need to be said are absolutely true and are a lot of homework for us. Isaac on my team is our vice president of investments and diligence, and he's just a really thoughtful individual. And I would say, on average, between the time we meet a company and the time we choose to invest, we're probably spending 40 to 50 hours of time researching these companies. I mean, you're talking full weeks of work across the board, and that's really encouraging to me and gets me really excited about the quality of decision making that we're bringing to the table. Isaac has built a really fantastic diligence process within the context of our organization. We have what we call level 1 and level 2 memos. Level 1 memos are the exhaustive. On average, they're probably 20 to 30 pages. And they go into every single detail about the business, every single detail, the good, the bad, the ugly. I mean, what people have to appreciate is we're talking about the venture asset class here. None of these businesses are perfect. What we're doing is making a decision as to whether or not we are comfortable underwriting the risks that are present in the company. That's an important methodology and kind of mindset to bring to the table. So what Isaac does, I'm so glad you asked this question, because I think a lot of firms have pretty subpar investment decision-making processes, largely because a memo will be distributed and then everybody will come together. But what happens, Mark, is the loudest voice in the room, which I'm, as a founder of 11 Tribes, is typically my own. And also I just have a loud voice. They'll make a comment and then everybody will kind of like fall in line, right? Well, yeah, okay, Mark said that. Like, okay, that's probably right. Like, I'll poke here or there, but I'm not going to have a totally different perspective or opinion. That's the opposite of healthy conflict. That's the opposite of making great decisions. So here's what Isaac did. Really simple. He builds out the memo, call it 30-page memo. We all get it 48 hours in advance of what our investment committee meetings, which are on Tuesdays and Thursdays. And then he gives us a Google form. And the Google form is 4 different pages. And it goes across probably 25 different questions, right? On a scale of 1 to 5, what is this founder's humility? What is this founder's smarts? What is their hungriness, right? Are they the ideal team player? Okay, cool. Next page. What's the quality of the market? What's the recession nature of this industry, right? Is this very cyclical or is it not cyclical, right? Market style questions. And then the third page is the business itself. What do we think about the business model? 1 to 5. Is it good? What do we think about the valuation and the price? What do we think about the deal terms? And then the last page is open text, right? What are the biggest strengths, weaknesses, and concerns that you have about this business? We have created incredible, organizational commitment across all. We have 3 partners on the investment committee that each time we have a deal that's ready to be reviewed, you are going to come to that meeting having completed that form, and you are going to be willing to adamantly defend your opinion because we have it here in front of us. And so you can't tell us that you thought something different. It is so fun, Mark. It is so fun because we get into that meeting and I'm telling you, man, like the gloves come off, because I've staked out my position. I'm not going to change it now, and we've got really opinionated people on the team and I love it. It's one of my favorite calls of the week because it's a debate of ideas in ways that very rarely I think people get to engage in. And so the run of show on that call is Isaac gets on. The form is intentionally anonymous to start, right? Okay, 2 people picked 4, but one person picked a 2. Who's the 2? Do you want to talk about it or no? And people can choose whether they want to engage. But by the end, I mean, it's a rip ruckus, man. We're digging in and we're fighting. And I'm really proud of that decision-making process because I think it creates true intellectual honesty. And I think it lets us really wrestle with the ideas and the risks that we have to take.
Well, and the flip side is it surfaces consensus. So you can be a lot more efficient. I won't name names, but I've sat through an awful lot of investment committees where people were just trying to show how smart they were. It's a massive waste of time, and we all agree with them. And can we please move on? And you guys, it's like, okay, we all rate the guy a 10 for this, or she's a 0 on this, and we all agree. We don't need to debate it, but what are the things that need to be debated?
I think it's an incredible process. And what's unique about our organization that allows that, Mark, and I didn't know this as I've been building this firm, but I think a lot of venture firms, any investment firm, associates or presidents or whatever, vice presidents, they're expected to kind of run the gambit of activities in the context of a firm, meaning you source, you diligence, you bring to investment committee, and then if we do the deal, you get to be the person that is on that deal, right? That's a tough thing to ask everybody to do because sourcing is a lot different skill set and activity than diligence. And so what we've created is actually we've come to use this word, interdependent organization. Isaac doesn't source. Isaac is diligence. He's focused on that and that alone. And then I've got Keegan on my team. And Keegan has a totally different skill set. By the way, we use Culture Index. The Culture Index for what makes someone great at sourcing is way different than the Culture Index that makes someone great at diligence. And so we looked for that different profile. And then Keegan doesn't diligence. He meets new founders. He gives them an initial pass based on whether they fit our strike zone. And then if they do, he introduces them to Isaac and to the partners to help evaluate whether we make an investment. So it's a really fun structure we have here. It requires zero ego, because if it's about you and your ability to get deals through, like, you're going to become a bottleneck really quickly. And so we talk a lot about the culture at 11 Tribes, and that's created, I think, a really efficient and dynamic process.
So on NQS, what were some of the big issues? You mentioned it's pre-revenue, which is a basket of issues, but what?
That's the elephant in the room. Yeah.
Given that what were the other issues, and what were the things you debated?
Yeah, I'd say there were three. The pre-revenue is top of the list, right? And we just had to decide whether we were comfortable with that risk. The second was small market. It's really easy, and I'm happy to talk about, we'll get to performance and things like that, but it's really easy because the company's doing well to talk about it now and be like, well, it makes so much sense, But when you map out that market and you understand the market share that they need to have in order to return the kinds of capital that we are looking for, it's a big number. It's a big percentage. And so, hindsight's always 20/20, but we really wrestled with, are we comfortable going into markets of this size and of this scope? And I think the quality of how they have performed has really helped us get more comfortable with, as long as there aren't incumbents that are actually doing well. There's a lot of opportunity in this emerging AI market for very underserved sectors to have game-changing solutions. So that's really the second one. And then the third was, and this has borne itself out, it was a team debate. And there was some questions around whether the CTO, who was on the team at that time, was the right person to continue moving forward. There had been some delays in product development, which is why they were still pre-revenue. And we had some honest conversations with Mark about, do we need to make an adjustment at team? Are you willing to remove this person if so needed? And a lot of those things that we suspected might have to happen, Mark, have borne themselves out. There continue to be a few more delays, and you can't have that at this stage of a company. And it reflected, I think, on the kind of leader that was in that position. So it really ran the gambit. There was a lot of risk to this, but yet three things kind of mitigated all of that. Mark Feinberg is an incredible leader. He's a man of remarkable integrity, and he's humble, hungry, and smart. That gets us so excited. The second was the customer contracts, the hospital contracts. Never heard that before. Literally never heard a company that's pre-product, pre-revenue having customer contracts. And then the third was our operating partner, Carolyn Wilson. And Carolyn sits on an advisory board with them now and is doing a great job. And, she just had a ton of conviction for it. And we listened to the people around us that orbit the decisions with us that have deep and abiding subject matter expertise. And Carolyn is among them. So it was a great process. We felt really good about the outcome. And the assumptions that we felt would bear themselves out have proven to be true.
You had mentioned that it was a priced round. How did negotiations go? How heavy was the lift to kind of get the deal actually documented and closed?
Well, anytime you price it, the lift is bigger than a safe, of course, right? There's hundreds of pages, right? You're putting in governance and charters and all these things. Mark Feinberg had always been someone that prioritized the right partner over the right price. We invested in the first round at a post-money valuation of $8 million. I think the pre was 6, and I think he ended up raising $2 million. And that was between us and Long Run Capital, Wilson and his team. I think folks that aren't comfortable with venture maybe struggle to understand those numbers at times. I've met a lot of LPs, limited partners in our fund, who just like, how can you value that at $8 million? Well, in venture, we're not just underwriting to what you have done, which of course was nothing. We're underwriting to what is the overall potential success and scale of this organization. 8 it's very unusual to find a multi-time founder like Mark that has a clear market opportunity, that has existing revenue, or, how should I put it? Predictable revenue opportunities in the pipeline. To find something like that's raising on anything less than a $10 million valuation is very unusual. Very, very unusual. It's easy for a founder to be like, I've got a great business. What's a nice round number I can raise at? Let's call it a 10. But Mark always prioritized partners over price, and I appreciated that about him. So the negotiation was not intense. We always felt that number was very fair. We were excited to participate in that. And ultimately, we wrote a check for $750,000 into that round. We took a seat on the governance board. I am the board member on that company now. And as we talk about our methodology, that's really important to have that board seat so we can continue to help influence the trajectory and the growth potential of these businesses and really help them understand, like, again, there's more than one way to build a successful business. You don't have to get on that growth at all costs hamster wheel. You can think about sustainable, profitable, durable growth and ask yourself, like, what if I don't have to raise the alphabet soup of financings, right? If I raise a seed in a Series A, but then I don't raise any more capital, is that okay? Yes, it is. So long as you can continue to build the business and scale the business at the pace at which you desire.
When exactly did it close, and how are things going from a both product and sales and marketing standpoint?
Yeah, so the round itself closed March of 2025. Within 4 to 6 weeks, the product was live. So it got into market. And so this was last year. And the receptivity has been incredible. It's been absolutely incredible. Just out of confidence of the organization, I don't want to share live revenue numbers, but I can confidently say it's grown hand over fist. And I think the progress of the contracts and the customer relationships that Mark has been able to make is it's exceptional. It's one of the fastest growing portfolio companies that we have. And again, it comes back to the assumptions we made, Mark, which were small market, yes, but incumbent is terrible and the pain point is ridiculous. Are there other startups in this space? One or two, but they're not focused on specifically this trauma registry space. So to answer your question very directly, it has exceeded our expectations from a revenue perspective, from a customer perspective, from a execution perspective. Mark has done better than we could have expected. And that always creates interesting questions, right? Because you always have one set of expectations, but when you have outperformance, it's easy to allow those expectations to drift and ask questions like, is there more that we can do? So as a board member now, that's really the conversation I'm having with Mark is, how big is big enough? What are you excited about? What outcome is enough for the blood, sweat, and tears that you've put into this organization? And those are privileged conversations to have, right? A lot of founders don't get to that point, but it gets us really excited. And it's worth noting, Mark King, that we've now put 2 additional tranches of capital into this organization fairly quickly. Yes, one was a little bit smaller, and then just 3 weeks ago, we put in an additional $750,000.
Usually people will tell a story about going to the first board meeting and they'll flip to the 3rd page of some memo and there's the big aha moment. Have there been any big negative surprises that once the deal closed?
Yeah, that is such a visceral comment you just made. Gosh. What is it about that first board meeting, Mark? It is a doozy, isn't it? Oh boy. The biggest aha, the biggest frustrations have been in product development with this company. It comes back to team. The right team, both internal and there were some external resources that were supporting. It just was not the right team. And so that has required some hard decisions on the leadership team's part, getting the right people on the bus and the right people in the right seats. But I feel really encouraged by the willingness that Mark Feinberg has shown to make difficult decisions. That sounds so easy in practice, but when you're in the middle of it and people have shown you loyalty and they've been there since the start, or whatever story that you've got in your own mind and whatever narrative you've told yourself, making the right decision that might hurt at the time, but is right for the overall stewardship of that organization is really tough to do. But Mark has shown a willingness, a propensity, and a courage to make those decisions. So yeah, I remember that first board meeting. Yeah, the product development was slower than we wanted. It had already created delays in getting the product to market. But then as it was in market, we weren't able to make updates. There were just all these delays, right? And what was interesting is that's kind of the inverse. I think a lot of times what we see is product development's going great. We're shipping all these new features, and yet we can't find new customers. That's really I would much rather have, hey, the product isn't working, but the customers are scrambling for this thing, right? They're desperate to have it in their hands. I'd much rather have that version of the story than product is great, but we can't seem to find any revenue. It goes back to the old saying, you could have the greatest idea in the world, but if you don't have a distribution mechanism, if you don't know how to sell it, you're dead in the water.
So as you're sitting here today thinking about kind of the overperformance, What is next on the horizon? Are you guys thinking quick exit, thinking another round? Where's everybody's heads
Right.
at this point?
Yeah, I mean, the spirits are high. Those are fun board meetings. We like those board meetings. I mentioned we've made a few more investments. The one we just had is effectively a Series A. He's achieved certain performance metrics that have warranted a Series A. It was really internal, Mark, which is cool. One of the things I love about our methodology as investors, where we talk about that founder outcome, is we build relationships where these founders get to a point where they're like, you are the firm and team I want to continue doing business with. And that's happened time and time again, where companies in our portfolio jump out of the gate real fast, and then they need more capital to meet customer demand. And instead of going back out to the market, they come to us. That's incredible. Those are incredible opportunities to take an additional stake in these organizations. I think where we are right now is let's have a great 2026. Let's continue seeing that growth. I think it's too early for acquisition conversations. Inevitably, those are going to come. I've gotten probably half a dozen private equity firms reaching out to me directly saying, hey, congrats on NQS. Would love to talk about it. And I politely declined because ultimately, and I say this in all sincerity, it's not my decision. I'm a steward. I'm a supporter of what Mark is doing. I will tell him exactly what I think. And then I will honor him and allow him to make the right decision, because this is the thing that he took on a lot of risk to build this thing. And it's ultimately his decision to make. So I say that in a way that, like, yeah, I am a board member. I have a vote in what we'll do, and I'll exercise that vote to my full extent. But I think that's such a different aspect of who we are at 11 Tribes, of like, I don't know more about NQS than Mark Feinberg. He breathes, eats, sleeps this thing, right? And I get to think about it a couple hours a week and support him, and then I'm on to the next portfolio company. So that's an important disposition for us. I'll tell Mark Feinberg precisely what I think, and I do think this has a ton of potential and is going to create a lot of value for a lot of people.
One other thing I'm curious about, you've mentioned the incumbent several times. Any competitive reaction from the incumbent?
So I don't mind sharing their name. They're a big public company. This is like a Reddit review. I'll tell everybody how we feel about them. It's a company called ESO. I don't even know what that stands for. It might not stand for anything, but the website is eso.com. And if you go, you can see, I'm looking at it right now, Mark. Okay, they have a column for EMS, fire, hospital, government, research. Those are all the different categories they're a part of. And if you scroll on each of those, you'll see they've got another 10, 15 different categories below. So they do a little bit of everything, right? There hasn't been a response yet. And I think that is actually something we've talked about at the board level, right? Like, we don't want to poke the bear, so to speak. But I will tell you that Mark Feinberg has brought over some technical resources from ESO. So people are starting to realize that maybe they're not on the right ship, and they're looking for an organization that's going to build with care in a way that builds a product that is really going to delight the customer. So no noise quite yet, but I certainly suspect that at some point, maybe this year, a conversation between us and their leadership is going to come to fruition.
Which raises another strategic question, because that is one route. I mean, do you guys think strategically about broadening the offering within the hospital, or taking that kind of core technology and finding maybe other places where it would be a similar... I mean, I'm trying to think of places that are similar to ERs, and I can't think of one off the top of my head.
It's a good question. And the answer is more the former. The platform itself is pretty unique and bespoke to trauma. But what's interesting is as you start to land and expand, there's more opportunities even within trauma. So it comes back to this vertical idea here, right? Like, there's a verticalization that can occur where it's like, we're not just the platform that allows you to log and make sure all the codes are in place, but we are also the platform that is helping with transactions. We're also the platform that is helping you process insurance claims. So you can start to think about what are all the transactions that are happening through this registry, trauma registry software platform, and then how can we continue to make ourselves a more meaningful part of each of those transactions. So without getting into much more detail than that, that is certainly where his mind is going. And that gets really attractive as well, right? I mean, the business is going to do great just on a software subscription model. But if he can move it into a place where we're now actually on a transaction by transaction basis, benefiting from each of those, that takes this business to a whole nother category in terms of its potential.
Mark, I appreciate you taking us deeper on NQS. Let's zoom back a little bit. What's next for 11 Tribes? You have closed Fund 2, which in the venture world is a huge milestone. So congratulations on that. But what's the agenda for 2026?
Yeah, well, you're right. This Fund 2 was a big deal. And we're grateful and humbled and honored to be stewarding that capital. The end of last year and early this year, we're in almost like a team scaling mode, Mark. We hired someone to help on the sourcing side. I mentioned him a little while ago, Keegan. Probably right when this podcast goes live, we're hiring an analyst to join Isaac, a gentleman named Jonathan, who's going to help on the diligence side because we're seeing a lot of deals and it's quite a burden in a good way. But the rally cry for this year is to find and fund the companies that we want to make a part of Fund 2's portfolio. So we've got, like I said, 14. The goal is 25, give or take, in total. So we'd like to be pretty fully deployed out of Fund 2 over the course of the next probably 12 to 14, 16 months. So that's a deal-ish a month. And given how much we underwrite, I talked about that process. That requires intentionality and pace. So that's always really exciting. I'm just obsessive about culture and building all of these component culture pieces into our firm as much as we encourage the founders we work with to build it into theirs. I love that stuff. So if anyone wants to talk about it, give me a shout. And then the big bogey, and this is kind of the world you submit yourself to when you're a fund manager, is the next fund. I've never been more convicted about the quality of our thesis than I am today. I've always appreciated the why, but to have this what, and to have a really defined strike zone in terms of the kinds of deals that get us excited, those deals are only increasing in frequency as founders, entrepreneurs, people who have been in industry and now are realizing AI can solve a really meaningful problem for them. They're going to be building more and more companies over the course of the next decade, and I want to be a part of those. I really, really do. So Fund 3's, 12 to 18 months away, but you know what it takes to get a fund off the ground, Mark. That requires a lot of foundational work that probably begins, sometime later this year. I'll say I, and maybe it's good or bad, I'm not sure, but I actually love fundraising. And you know me well enough to know that's not surprising, but the 11 Tribe story it's not a normal venture story. It's very personal to who I am and is very integrated with my faith. And so I feel like when I pitch, it's actually an opportunity for me to share how my faith has impacted the journey that I've had as an entrepreneur. And what more would I want to do with my time? What else would I want to be doing with my time? That gets me so excited. I feel so blessed to be able to do the work. And so the idea of another fundraise is something that actually deeply energizes me.
You mentioned getting in touch. What is the best way to learn more about 11 Tribes?
Our website talks about all our deals. We got every single founder on there. We put pictures of the founders, not just logos of their companies, because that's who we are. We care about them as people. So check that out and take a look at NQS and dig into Mark Feinberg's company. And then if you want to reach out to me, LinkedIn's a great place to find me. And Mark, I love your audience, so they can just have my email and reach out to me directly. It's just Mark, M-A-R-K, at 11tribes11tribes.vc. So would love to hear from any entrepreneurs, anyone else that, if you want to see the handshake, shoot me a note. I'll pass it to you. We're very open-handed with that thing. Everyone should have their own philosophy of partnership. Everyone should. And so if you want to use mine as a template, if you want to use that as a foundation to build your own, great, do it.
Mark, I really appreciate your open-handedness and open sourcing, the culture building stuff that you guys do, because I think you guys are on the leading edge of that, and it's great to be able to talk about it. So I appreciate you taking the time.
Great to be here, Mark. Thanks so much.
I hope you've enjoyed my conversation with Mark Phillips of 11 Tribes. Mark is, as you can tell if you've made it this far, a venture capitalist that thinks a little bit differently than most of the industry. As I mentioned, Mark does have a podcast. If you've made it all the way to the end, you must be a lover of podcasts. His podcast is called Masters of Resilience. He co-hosts that with Ryan Seeger, and they talk to all kinds of folks who have been through the highs and lows of the business life, investing life, entrepreneurship, and really dig into this question of what makes a resilient founder and a resilient business person. So strongly encourage you to check out Masters of Resilience with Mark and his co-host Ryan Seeger. He is also super active on LinkedIn. Again, it's just Mark Phillips on LinkedIn. And if you want to reach out to him via email, that's mark@11tribes.vc. Again, it's Mark with a K and 11, not spelled out. So it's 11tribes.vc. You can get all these links and additional information in the show notes, and you can find those at impactinvestingroadshow.com/11tribes. If you've enjoyed this conversation and maybe learned a little something, could you do me a personal favor and think of a friend that you know would really enjoy this or learn a lot from this episode and forward it to them? Would really appreciate that. They will appreciate it, and I certainly appreciate it as well. So until next time, I am your host, Mark King, reminding you that if you want to move the impact needle, you got to step on the gas.
This podcast and related content are for informational purposes only and do not constitute financial, investment, tax, or legal advice. Always consult a qualified professional before making any investment decisions. All opinions expressed by Mark and podcast guests are solely their own and do not reflect the opinion of the firms they represent. Facts are believed to be accurate at the time of publishing only. No effort has been made to verify facts presented by guests, and no updates have been made since the date published. This podcast is not and should not be construed in any way as a solicitation for investment or an offering of securities. Mark and guests may own positions in securities discussed. Impact Investing Roadshow, Mandorla LLC, guests and Mark King disclaim any and all liability for actions taken as a result of listening to or reading this educational content.